On Wall Street, power usually means an owner, a chief executive officer to blame, or a shareholder to answer to. Yet in the heart of global investing, a trillion-dollar force operates with no owner, no boardroom to storm, and no profit-hungry shareholders, just millions of retirement savers, their pensions, and a system built to run at cost. The official story says this keeps fees low and priorities aligned. But what if the very structure that made investing affordable now quietly shapes markets from New York to the City of London to Sydney? If you have ever trusted a pension, a 401k, an individual retirement account, an individual savings account, or your future to a faceless fund, you are already part of the puzzle. But who really holds the reins? And what unseen risks does this no-owner machine create for the world's savings? May 1st, 1975. In a quiet corner of Valley Forge, Pennsylvania, John C. Bogle sat across from a divided boardroom. Months earlier, he had been forced out as chief executive of Wellington Management after a bitter dispute over mergers and strategy. Now, stripped of his title, Bogle faced a crossroads. The solution wasn't a comeback. It was a breakaway. He convinced the boards of 11 mutual funds to take a gamble, split from Wellington and launch a new company with just 28 employees. The arrangement was radical for its time. Instead of chasing profits for outside owners, this new entity would serve only the funds and their investors. Vanguard's first year began with 372,648 accounts and an average expense ratio of 0.66%. No Wall Street backers, no commissions. Just a group of staff, a handful of funds, and the promise of a new kind of financial company, born from crisis and risk. Index funds flipped the script on Wall Street. Instead of betting on which stocks would win or lose, John Bogle's idea was simple: own every company in the market all at once and keep costs as low as possible. This approach, now called indexing, was ridiculed at first. Critics called it lazy, even un-American. But Bogle pushed forward, launching the first retail index mutual fund in 1976. He argued that for long-term savers, the real enemy was not market swings, but high fees and constant trading. Great long-term rewards can result from small differences in cost, Bogle said. The math was on his side. Shaving off a single percentage point in fees could mean tens of thousands of extra dollars for a retirement account over decades. Indexing made investing boring, but it also made it fairer. The promise was simple: if you own the market and cut out the middlemen, more of your money stays working for you. Vanguard's ownership chain is unlike anything else on Wall Street. At the foundation are the funds, hundreds of mutual funds and ETFs, each a separate legal entity. When someone invests in a Vanguard fund, they become a shareholder in that fund, not in Vanguard itself. The key twist is every fund, from the smallest bond index to the giant S&P 500 tracker, collectively owns 100% of the Vanguard Group. There are no outside shareholders, no private equity firms, and no stock market listing. The result is a closed loop. Investors own the funds own Vanguard, and Vanguard exists to serve only those funds. Think of it as a co-op, but for trillions of dollars in retirement savings. This structure is only possible under US law, and it means Vanguard operates at cost. Any surplus from running the business gets funneled back as lower fees, not as profit for corporate owners. The incentive is simple: keep costs down and pass the benefits to investors. Today, Vanguard manages around $12 trillion for investors across the globe, more than the GDP of Japan or Germany. This scale did not happen by chasing headlines or launching flashy products. Instead, Vanguard has cut fund fees over 2,000 times since 1975. Each cut, sometimes just a fraction of a percent, adds up. For a typical retirement saver, that means tens of thousands of dollars that would have gone to Wall Street now stay in their account. The average expense ratio for a Vanguard fund is now measured in basis points, often less than 0.10%. As trillions of dollars pour through 401ks, IRAs, ISAs, and Australian super accounts, the impact ripples out. Lower costs mean higher compounding, and over decades the difference is dramatic. But with so much money under one roof, Vanguard's influence is not just about saving investors money. Its reach now extends into boardrooms, shareholder meetings, and the voting ballots of nearly every major company in the world. Proxy voting is when someone casts ballots on behalf of shareholders at company meetings. Think proxy and votes being cast in place of individual investors. These votes decide who sits on corporate boards, how much executives are paid, whether companies merge or split, and which major proposals get the green light. Every year, ballots land on topics like director elections, chief executive compensation, and shareholder resolutions, sometimes thousands at once. For most retirement savers, these decisions happen quietly, handled by stewardship teams at firms like Vanguard. Wall Street, the City of London, Sydney boardrooms, shareholder meetings, and brokerage screens all show the same pattern, where votes are filed by a small number of managers. The rule is simple: if you own shares, you get a vote. But when millions of people own shares through index funds, the job of casting those votes shifts to the fund managers. That shift in responsibility changes how influence is exercised on behalf of millions of retirement savers. In 2021, a tiny activist called Engine No. 1 took on ExxonMobil's board. Vanguard, holding over 8% of shares, cast its votes for all 4 dissident nominees. 3 seats flipped, an energy giant's future changed by ballots from index funds. Every time you check your pension or ETF, unseen votes shape boardrooms from Wall Street to Sydney. Ownership may be diffuse, and the power behind your investments has never been more concentrated. Share your stance below.